trend following is very dependent on a goal based. So, in other words, there are trend followers that are very sensitive to daily charts. And are responsive to far more often getting in and out of a move to make sure that they get in early on some of the bigger trends that they will stay in. Others will take the lag that comes with far less entries and exits and ensures that that bigger trend that lasts is the real one.
Hmm.
And you don't get easily noised out, and we trend follow a number of commodities, and we use a couple of lagging moving average techniques and things like this to derive what we define as their primary trends. But we always do like to always recognize that you want a macro tailwind. You don't want to just be taking a commodity trend trade without having a structure as to why this trend could, be the one that's worth taking this in a more meaningful size. Trend following does work. And in fact, I would argue trend following is going to be far more important this decade than it was last decade. Buy and hold investing and passive investing ruled the last decade. The 2010 to 2020 crowd had one amazing, beautiful, clean buy and hold trend that they could have lasted for a whole decade. Because of inflation, high interest rates, geopolitics, deglobalization, all of these different factors playing in, it is very likely that buy and hold investors are going to be the ones that are going to be the most disappointed. And it doesn't have to be disappointed from a market crash perspective. Disappointed that they're not getting their 5 to 10% a year that they were always used to in buy and holding mutual funds. And what's interesting is if you take for instance, the trendless period of the 1970s, and you take from early 60s to late 60s to the early 80s, and you take that kind of 15-year window, the Dow Jones and the S&P was literally flat for almost 10 to 15 years. But yet, during those cycles, there were at least three legitimate bear markets that were of the 25 to 40% declines. There was at least three major bull market runs that were of the 50 to 80% rallies that
Yeah.
were lasted a year or two. And yet, if someone just bought and hold, they went on the mother of all roller coaster rides.
Right.
And as someone who even just had the most rudimentary trend following a technique, would have at least had a chance to capture those up and down cycles within it. And I feel that because that is much more likely that this next decade will be far more disappointing for that, the trend follower, I think, has the best chance.
So can you give an example of like a basic trend to follow? I mean, I think about energy over the next decade as something as a good example of that because it seems kind of like a no-brainer with what we're doing with CapEx, ESG, all these other things. It just makes sense to me that energy is going to be a big concern, and it seems like a
Yeah, okay,
trend.
but you're
Or am I looking at it
you're
differently?
trying to macro pick the themes, which I think is important. But
Okay.
generally, when trend following, you do want to have a proper mix of assets.
Okay.
And so in this situation, you know, uh, you have to be trend following. You have to be trend following some degree of different asset classes to try to capture some of these moves. And I think just for the average beginning listener, some sort of a moving average technique, uh, something of the something that is greater than a 20-day moving average. Like if you're staying with 10 and 20-day moving averages, you're going to just be whipped in and out too
Yeah.
frequently. You want to slow those down a little bit to make sure you're capturing the bigger trend moves, right? And
Yeah.
I think you can give that a go.